Hi, this is Lex, and welcome to the Fintech Blueprint. It's your podcast about fintech, decentralized finance, digital banking, investing, robo-advice, artificial intelligence, and all the other frontier technology that is transforming financial services. To get more content, like an illustrated transcript of this conversation in your inbox, subscribe at fintechblueprint.com. So without further delay, let's jump into today's episode. Hi, everybody, and welcome to today's podcast episode. I'm really excited to have with us Jesse Proudman, who is the Vice President for Crypto Investing at Betterment, one of our favorite robo-advisors. He was also the co-founder and CEO of Makara, which is a crypto investing firm that was acquired by Betterment, as well as a repeat entrepreneur. So I'm really excited for our conversation today. Jesse, welcome to the podcast.
Thanks for having me. Excited to be here.
So let's start with the entrepreneurship bug. You seem to have been bitten by it pretty early on in your career. Can you tell us about what pulled you into kind of becoming a founder of your first set of companies and what kind of work those companies did?
Yeah, absolutely. It all comes down to a CD Walkman. That was the start of everything. So way back when, I wanted a CD Walkman and my parents said, go get a job. And I looked in the newspaper before Craigslist was a thing and did not want to go sell shoes in the mall or sell smoothies, and decided, hey, this is sort of late 90s. I think there's an opportunity to go build websites. So hopped on my biked around town and sold my dentist the first website. And so that sort of started my entrepreneurial career. And that company morphed a few times into effectively a web design and hosting firm. We ran servers, we built websites, and that kicked everything off. That was 25 plus years ago.
Amazing. And is that Blue Box Group?
Yeah, so that became Blue Box Group. So Blue Box was started my senior year of high school, freshman year of college, and very much like my roots, started doing web design and web development for that firm. Had a falling out with a previous founder of a company we were running together, and decided to go out on my own, try a stab by myself, and that was the Blue Box origin.
It's pretty early on in your career to try to stand on your own. What were some of your early learnings and challenges in trying to build that business? And maybe one of the things I'd love to know also is, like, how did you connect the dots between designing websites for the local dentist to really running cloud as a service and getting acquired by IBM? Like, there's a yada, yada, yada in there that's really interesting.
Yeah, the whole Blue Box story for me was funny. It just sort of was the startup experience that sort of never felt like it should have been a success. We sort of stumbled our way from one thing to the next, and it worked out wonderfully. So I had started that firm effectively doing web design. I had left the previous company I'd been a part of owing about 30 grand in debt as part of sort of my separation from the firm, and needed a way to pay that off. This was freshman year of college. And so started these consulting projects, basically building web apps for people, kind of 2003 at this point. So a lot of sort of e-commerce platforms for various companies. When we built them, we also would host them. So we physically owned servers that we ran in data centers, and we would run the websites on behalf of the customers. And by about 2005, the hosting side of the business had grown large enough where the revenue there was effectively sufficient to cover all the expenses. And that seemed like a more interesting business to me than the web development side, sort of this notion of recurring revenue. And on the development side, you get this challenge that it's a perpetual project. Like, clients are always looking to make modifications. And so things never really ended. And there was always this disagreement around what was in scope and out of scope for a particular project, where the hosting side was very clear. You're effectively sort of a landlord to some extent on the hosting side. You're buying equipment and then renting it back to somebody on a monthly basis. And that seemed to make a lot of sense to me. And at the time, Ruby on Rails as a programming language was just evolving, and there weren't specialty providers sort of focused on that framework. And so I saw an opportunity to really lean in, find a niche, and build a business targeting a kind of a emerging sector of the space. And that seemed to go very well. The challenge with that business is that, at least our challenge with that business, and obviously companies like AWS have figured this one out, but sort of as we grew, so too did our debt, right? So every time we brought a new client on, we had to go purchase equipment to provide the infrastructure for that client. And that was all debt financed. And we were growing so fast at the time that the debt too was growing so fast. And it just sort of felt like it was becoming this sort of perpetual problem. Like at the beginning, I remember I had to sign personal guarantees for 50 grand or 200 grand or $500,000 and just being terrified about having to sign that guarantee. And then as we continued on, started to sign guarantees for $1 million or $2 million bucks. And it just started to become comical to some extent. Like, what's the bank going to take? I don't have anything to really back these up. But that was the name of the business. It was kind of this perpetual challenge to go find financing to operate the infrastructure itself. And so as we looked at that, we started to try to figure out how do we go take everything that we've built, the technology and the experiences that we've had, and build a little bit more of a repeatable business with a higher margin. And at that moment in time, so this is now sort of 2010, cloud has emerged as a delivery mechanism. Sort of the banks, insurance companies, healthcare companies were still sort of hesitant around cloud. And so we started to realize there was an opportunity if we could build this notion of a private cloud product, one where you get the benefits of using a cloud provider, but the infrastructure sort of belongs to you. It's not shared amongst a bunch of other people. If we could do that in a repeatable and reliable way, sort of stamp these out, that there was something really compelling about that business. And it allowed us to have a higher margin. It allowed sort of the business to be more repeatable and to get off sort of that debt train to some extent. So we ended up raising venture money to take the platform that we had built to go build that product. And ultimately, that's what IBM acquired us for, was for this private cloud as a service platform.
That's really interesting because I feel like this idea of a public internet versus a private internet, a public cloud versus a private cloud, a public blockchain versus a private blockchain, like these things continue to echo, but the solution that they land on, like the equilibrium, is different, right? So for the internet, there is really one public internet and the intranets don't really matter. For cloud, like you say, there's still a portion of the market that is dedicated, that is not shared. Why do you think these industries kind of solve to different answers?
It's actually, it's interesting. I think they all ultimately solve to the same answer. Like private cloud at the time worked from a marketing perspective and really from a client desire perspective. I think because of this kind of like the fear, uncertainty, and doubt of something new. And so these firms would go and they would look at Amazon and they would say, well, it seems really compelling, but I'm sort of afraid of not knowing sort of where my data sits or how these things work. But over time, everybody became comfortable and confident with the public infrastructure. And so this desire to have private infrastructure really began to wane pretty dramatically. So sort of our timing with the IBM acquisition was great in that I think if we kind of had continued on our own for another 4 or 5 years, I think we would have seen sort of a lack of interest in this private concept. And so as I see sort of these emerging trends, this notion of, hey, I want some of that new technology, but I want to kind of keep my hands around it. That always seems to be the de facto go-to play for corporations. And then as they gain more comfort, sort of the public concept becomes more and more comfortable. And I think you're exactly right. We saw it with the internet, you see it with cloud, and then even all the blockchain projects, like back in 2016, 17, I mean, IBM's whole blockchain division, their whole pitch was sort of, we'll get you this private blockchain. That ultimately was not a huge success because you're sort of missing the benefit of scale of all of these existing pieces of infrastructure. And ultimately, people just become comfortable with the new emerging thing.
Yeah, that question was a bit of a lead on. I'd love to learn how you became interested in blockchain at IBM, but it's exactly this trap of we don't want to adopt the public chain, so let's have our own private consortium. And the trap you fall into is exactly the one that you've described around the cloud business as well, which is you have this like massive startup fixed cost. And if you want to grow, it takes a long time to get away from the fixed costs and to get the benefit of this global, gigantic public good. And so it's AWS, once it's scaled, then on the margin, your customers start to become valuable and profitable. But building it out, your description of having to take out $1 million personal loans, I mean, it just sounds absurd. And in a sense, that's what the private enterprise blockchain players had to do. They had to take out $10 million, investments into private chains to try and stand them up. And still, that doesn't compare to the billions of investments that are going into the public chains. But I'm getting a little bit ahead of myself and would love to understand kind of what you did at IBM that pulled you in this direction.
Yeah, it was pretty fascinating for me. So 2016, IBM bought Blue Box in 2015. So spent about a year and a half after the sale integrating the product into the broader IBM ecosystem, sort of building the IBM version of what we had built. And at the end of that, had started to get interested in some other areas inside of IBM, one of which was IBM Ventures. I had gone to college with Eric Voorhees, who went on to found Shapeshift, and Nick Carey, who went on to found blockchain.com. And so was pretty close to them and had been watching over their shoulders as they had built their businesses over the preceding years, but never really had the intellectual bandwidth to go figure out what was happening in crypto until 2017. So moved over to work with IBM Ventures at the beginning of 2017. And my focus there was really to design an accelerator program for IBM Ventures. So Google had Launchpad, Microsoft had Microsoft Accelerator. IBM didn't have, at that point, sort of a centrally run startup accelerator program. And so I had designed an initiative there, and my focus for that was going to be on blockchain at the time. So IBM had 5 key priorities. It was like cloud, mobile, security, and blockchain. I can't remember the 5th, but that was what IBM was putting its energy and emphasis into. And so the accelerator was going to focus on blockchain, and I was going to be sort of the call it domain expert at the time. So spent most of 2017 researching what was happening in the space, sort of podcasts and blogs and Twitter and Telegram and Reddit, sort of trying to just digest everything that I could. And as I got deeper and deeper, I just got more and more excited. The whole industry reminded me so much of being back in 97 and sort of at the emergence of the commercial internet, where every day something is changing and evolving, and sort of the pace of innovation is incredible. And sort of at that point, I knew I wanted to do something directly related to this industry. IBM came back at the end of 17, decided there wasn't budget to start the accelerator. And at that point, I knew I wanted to go do something here. And so I decided to leave. And that was the start of a company called Strix Leviathan that ultimately became Makara.
One of the best logos of any company I have ever encountered is the Strix Leviathan logo. It is just fantastic. It is an owl with tentacles. Is that right?
Yep. Yeah. So we sort of Strix is an owl, and Leviathan we always thought of as kind of an octopus sea monster. And the thesis behind this logo was sort of an owl is always watching, always listening, and a octopus, big brain, many legs, sort of being able to multitask. So we sort of embodied those characteristics and what we were trying to build at that business, and then we came up with that wonderful logo.
So what was the business, and how did it work?
Yeah, so we started that company with sort of 2 theses. One was that effectively in crypto in 2018, January 2018, there was not sophisticated portfolio management technology for investors looking to do more than just sort of buy and sit on Bitcoin. So if you wanted to manage a multi-asset portfolio where you're buying and selling assets, it was quite a challenge at the time. And most of the funds that we knew were doing this in spreadsheets. Ironically, up until 2021, we still were meeting multi-$100 million funds that were managing their entire portfolios in spreadsheets because the technology just was so rudimentary. And so
it could be QuickBooks.
Yeah.
Not to point fingers at any particular 30-year-old, but it can certainly be worse.
QuickBooks and Excel. That's how so many things in the industry were running. And so we felt like there had to be a better way. And kind of coming out of my experience at Blue Box, knew that if we could build kind of the underlying software infrastructure, that whether or not we were directly able to monetize that there would be value there. So that was kind of idea number 1. And then idea number 2 was that we would be our first client. We would operate a traditional hedge fund, using that software to go algorithmically trade crypto, really with the objective of better risk-adjusted return. So how could we minimize downside as much as possible while still sort of having exposure to the upside in the asset class? And the belief was this is a sort of a behaviorally driven asset class. Sort of fear and greed move these markets, and they're reflexive, extremely reflexive. If we could kind of identify those behavioral characteristics within underlying trade data and algorithmically trade off that we could have a great return profile and sort of benefit economically from the volatility in the space.
Let's talk a little bit about that in terms of what algorithms could be built off a reflexive market. Because 18 to 21 is a very interesting period in crypto. It's a period of a very dead bear market coming out of the ICO collapse, and then some really intense exponential runs for particularly high quality assets, and then exponential runs for lots of low quality assets, and then a drastic sort of explosion. How did you try to model that? What kind of approaches did you use to try to think about it, and what sorts of investment strategies worked?
Yeah, we really picked quite the time to start an asset management firm in crypto. I think in hindsight, it's probably the worst possible time we could have started. But I think it gave us, so when we founded the firm January 1st of 18, like the markets completely collapsed sort of by March, April. And then we spent the back half of the year, with just everything falling apart. And so the interesting challenge was effectively trying to figure out how to build a business in that climate. I felt like particularly at the beginning, we were always a bit behind. Like it took us a while to figure out how to effectively short the markets. And sort of by the time we had figured it out, most of 2018 had passed, and it was no longer sort of as interesting of an opportunity as it could have been. And I think like looking back, we from day one tried to do everything quote unquote the right way. We were a US based firm. We were operating in Washington state. We must have spent like $1.5 million of our initial capital just on legal fees to set everything up. And you go to these lawyers and ask them, like, how do we create a structure that allows us to do what they want to do? And they don't have any idea. Like, this is all sort of Wild West. These lawyers are trying to understand how to build businesses in an opaque regulatory environment, making their best guesses. And the irony is that when they're wrong, you just have to pay them more to fix it. So the whole thing was such a challenging endeavor to get going. And so, like, whereas many firms at that time decided they were going to play fast and loose and went and traded sort of illegally on international exchanges and had opportunities at the time that we didn't, we took this sort of slow and meticulous, like, we're going to do this the right way approach that felt really challenging at the time. And now in the wake of the last sort of 8 weeks or so has felt really rewarding that we made those decisions early on. From a strategies perspective, at the end of the day, most of what we spent energy on were momentum-based strategies. So given the reflexive nature of these markets, sort of when they start to move, they continue to move for periods of time. And our belief was that we could identify those movements on different time durations and then trade effectively within those durations to benefit from those movements. And, I think it's a challenging and constantly evolving business. And, I've seen a lot of theories around sort of how the markets have changed over the last 2 or 3 years as more sophisticated market participants entered. And I think they're pretty spot on. Like 2017, 2018 definitely had sort of a different, like the behavioral characteristics felt different then. I don't know how exactly you would quantify that in data, but like the gut feeling is the markets behaved structurally different than they did in 2021 and even this year in 22. And I think a large part of that is due to who's involved in the markets and how they trade. But the momentum piece, it worked very well for what we were trying to achieve. And again, the objective here was not to go take a bunch of client money and go lever long Bitcoin on BitMEX and hope the markets go up. Our objective was really around how do we provide this better risk-adjusted return, given that this is an emerging asset class and to a large part sort of experimental in many characteristics.
How did you start working on Makara? And the way that I understand the difference is that you've got an asset manager where you're trying to discover strategies that work, and then you have a digital investing application, a distributor of crypto asset management product that is trying to find clients to pull in retail investors. They're pretty different missions and goals of those two companies. So what triggered for you, the desire to create the distribution platform? And then how did you think about growing one versus the other?
Yeah, it was a fascinating process for us. So we started Strix in 2018 and kind of continued to build that technology platform for the preceding years. Our biggest challenge in that business was raising capital for the fund itself. So that was a traditional hedge fund, sort of GP-LP structure. So our investors, we were limited to qualified purchasers. So effectively 5 million in investable assets and up, which is a sort of a small pool. It's basically family offices, high net worth, like extremely high net worth individuals, a lot of fund of funds. That was our clientele in that business. And it's just a challenging sales cycle. We did well raising money, but it was a lot of work. Through all of that, we consistently would get questions from sort of accredited investors, from our friends and family, from people in the industry, like how do I go invest in the asset class? Like, how do I get started? And we didn't feel like there was a great way for those people to go participate here. It's sort of like your options are to go to Coinbase and open an account and then go pick between, 150 different things that are all named peculiarly names, and you don't understand what any of it does. Like it didn't feel like a logical or sane way for people to get involved here. And so we really felt this desire to build something better and to build something that was accessible to everybody and to leverage that technology that we had spent the preceding years building to do that, to be the foundation for something new. So in the end of, I'm going to get my years right, at the end of 2020, we had this belief that there was a market opportunity and that we had the technology platform to go do it. That's it's the classic entrepreneurial process where you look at an opportunity and you think it's going to be really easy to go build and there's going to be a ton of demand for it. And then you begin down the path and it's never as easy as you think in any way. So for us, that challenge was, again, trying to do this in the quote unquote, the right way. And so we wanted to be a licensed or to be a regulated entity. And so we chose to build that business under the SEC's Registered Investment Advisor registration. Like that was the first of many challenges in Makara to go obtain that licensing and then build the technology platform and really all the supporting features and capabilities that license or that registration requires. There's a lot more there than I think we initially realized we were going to have to build.
Yeah, the digital wealth direction has a set of pleasures. I'll fast forward into Betterment and the Betterment acquisition. The context for our audience is Betterment is one of the first robo-advisors, arguably the largest independent robo-advisor. Much of digital wealth's investing philosophy focuses on simplifying the investment process towards portfolio selection. And the answers that digital wealth provides very often are passive portfolios. This is very good for people who want to delegate their investment decision, who don't want to be buried in a litany of investment choices and fiddling and optimization and trade optimization and tax management and all this stuff. It's not as much of a fit for people who want to day trade or who like hanging out on the Seeking Alpha forums or the Yahoo Finance forums and, twiddle around different stocks. The interesting thing is with the crypto world, much of crypto investment management is really trading and this kind of behavioral profile of, you talked about the momentum side, but it is like this retail day trader stereotype, almost the Robinhood crowd, much more so than the Betterment crowd. But the markets have moved on. We've had a really nasty crash. And in moments like that, people get educated about the value of long-term holding and, rebalancing and asset allocation, diversification. And so I'm really interested to hear kind of the transition between Makara and Betterment. And then how does the combined offering think about both, the asset management component, as well as the psychographics of like who this product is for.
This whole acquisition was fascinating to me because when we were out raising our Series A in the summer of 21, the pitch deck that we were circulating, literally like the title slide was building the betterment of crypto. So we always had looked up to Betterment as an example of the type of business we wanted to become, and an example of sort of the technology that we needed to go build. And so when Betterment, when Sarah reached out in October, November of that year, it was interesting. We actually had, the day she reached out, I had just received the term sheet for a Series A for the firm. And so we were sort of evaluating, do we go build this, continue to build this independently, or do we become part of sort of a bigger entity? And sort of all of that, I mean, everything that you just spoke about, all of the underlying infrastructure for client management, for tax reporting, for tax optimization, sort of all of the regulatory overhead of running the business. There was so much more than I think we understood when we started Makara. And there was so much more sort of value that we could bring to our clients, building in those features and functions into the Makara experience, that it just became a no-brainer to become part of an organization like Betterment, and really to leverage their experience and sort of decade plus of technology to benefit our clients. And so very thrilled that we did the deal and that we became a part of this organization. The Betterment crypto product, it's a long-term investing offering. So the thesis here is that this is an emerging asset class. We don't know sort of winners and losers. So trying to pick individual assets will be a challenge. Sort of the ability for a retail investor to short the markets, particularly in the US, is challenging. And so these momentum sort of strategies aren't particularly suitable or appropriate for that investor profile. And so instead, we wanted to build effectively the equivalent of an ETF or a mutual fund, but in a direct indexed methodology. So we have constructed model portfolios that have asset allocation to a number of different assets in the asset class. And we have an investing team that goes through and does an asset analysis, largely looking at suitability from a trading perspective. Are these assets, do they have the liquidity that we expect, and sort of how do they trade globally, and then construct our portfolios and allocations based on those pieces. And the idea here is that instead of trying to pick that individual stock, you would as a traditional investor, you just get exposure to the general crypto market. And as this market evolves, so too will these portfolios, and so too will your exposure. And it's a way to just participate without having to spend sort of months and months of time understanding the nuances of all these different assets, and really trying to keep up with sort of the rate of change that happens here.
Yeah, so the indices that you've got, which is like the whole universe, the metaverse, decentralized finance, like these baskets, how are they constructed on the custody side? Like, because you can't have ETFs, you can't have mutual funds. So what is it that is actually implemented?
Yeah, so this was sort of the neat thing about bridging the Makara technology together with Betterment's technology. So a registered investment advisor has a requirement to work with a qualified custodian to maintain client capital. So the investment advisor themselves is not sort of directly holding your funds. And so in crypto, there are sort of a handful of firms that could be considered a qualified custodian. This is effectively around how these firms are set up, how they're registered, and how they protect client assets. And we've seen over the last number of weeks that can be a really important decision in how you decide to invest in this asset class. And so we elected to work with Gemini as our qualified custodian. And so when you sign up for a Betterment crypto account, on the back end, you are getting sort of a separately titled Gemini account in your name. And then your capital is deployed into that account. And these model portfolios are then purchased on your behalf within your account. And so you're actually holding the underlying assets in your name. So when we mentioned sort of earlier, it's a direct indexed offering. You're not buying a share of a fund. You're actually getting the underlying Bitcoin or Ethereum or other assets that make up these portfolios in that account that is in your name at Gemini.
How do you think about custodial versus non-custodial holding of crypto assets? I mean, I think over the last several months, the lessons are both better, deeper regulation of centralized entities that purport to hold customer assets so that we have full transparency, but also some of the crypto ethos, which is, not your keys, not your wallet. So let me actually hold the underlying in some manner. How do you think about that ethos versus some of the regulatory realities of providing investment advice in the United States, which, makes that almost impossible to achieve?
Yeah, it's a great question. As an registered investment advisor, we are constrained to this custody rule. And so we have to work with sort of an entity that is deemed a qualified custodian, and sort of on-chain smart contracts don't currently meet that definition. So there's not a way for a firm like ours to deliver the product that we want to deliver and the experience that we want to deliver and maintain that regulatory status. It's sort of a challenging reality of operating sort of on this emerging asset class. On-chain products, and there are a couple that do similar capabilities that they're fascinating. And I think ultimately, as the industry evolves, that's where things will head. But in today's world, there are multiple challenges, including just the fact of sort of money movement and trade execution and the cost to do that on chain that make that type of offering impractical for investors with smaller balances. Like if you have an account with $500 in it and it costs you $5 every time you want to rebalance the portfolio, like that's not a particularly well suited product for an offering like this that has sort of the benefits of a managed index. So I think ultimately we'll get to off-chain offerings, but in the interim, these custodial products that focus their energy and time on building within the existing regulatory framework and sort of meeting those obligations. I think if you go and you find the right providers and you understand the licensing requirements and the kind of concept of qualified custody, that's one of the best ways investors can protect themselves today. And the challenge with the crypto is you get this mix of companies like FTX versus FTX US to somebody that's not actively participating in the space on a day-to-day business. It can be hard to understand the difference between what those two firms are and like why you would pick one versus the other. There's some challenge on the front end to sort of figure out how to participate here with the right set of vendors.
That's really interesting because I remember what you'd said about private cloud and how private cloud was, the right solution for some moment based on the maturity of the industry and the adoption curve. But over the long run, things will trend towards these big public goods that scale up and above, and people get used to particular behaviors. And so here, similarly, it's very possible that we'll end up in a place where people adopt behaviors that are non-custodial and where they're more actively using their crypto assets. But for the part of the adoption curve that we're in, packaging it in an easier way is still very useful and can help grow. I have a question as to how the crypto portfolios and their risk profile, given it's so difficult to model from a traditional portfolio optimization theory perspective, how does Betterment think about modeling in the full user journey, the full sort of financial picture in combining the traditional asset allocation with a crypto asset allocation? Like, what are some of the assumptions to make it functional and to be a good fiduciary?
Yeah, choice became really the key answer here. Our philosophy at Betterment is around investor choice and ensuring that we have sort of the products and features that allow investors to have access to the things that they're interested in. So these portfolios are opted into by Betterment clients. They are not part of sort of the core Betterment investing experience. So our Betterment crypto clients, they choose to invest specifically in these offerings. I think it's exactly for that reason. Sort of there's no way to put sort of a specific risk score on this asset class outside of acknowledging that it's incredibly risky. It is an emerging asset class that is full of experimental technology. Sort of you need to approach it with that understanding that you are an investor is making sort of a long-term investment in the success of this new technology. And the belief is that over the next decade, this technology continues to become more and more part of daily lives, and as such, sort of appreciates in value. But it's an experiment, right? It could be the opposite. We could see sort of the regulatory focus that the industry is going to get over the next couple of years create a ton of headwinds, and we could see a lot of challenge in the space. So sort of that's the first acknowledgement. And so we have clients opt in, and then we give them guidance. And we believe that this shouldn't be more than 5% of your investable portfolio. That sort of it's a very interesting asset class, that it can be part of your broader portfolio. But we've seen too many stories where people invest far more than they should here, and the volatility that we see creates too much economic harm. So big believers in sort of limiting exposure. Participation is great, but let's be responsible about it. Those two characteristics really make up the offering.
There's a very small portion of the RIA financial advisor industry which is starting to adopt crypto at the edges and, build portfolio management tools for it and so on. And I wonder how the state of the art will look like to incorporate it as an asset class, not as a separate kind of like behavioral failure that people have of like, okay, fine, you can invest in this, but how it can become part of financial planning, get integrated into unified performance reporting and just become part of the conversation. And I think one of the opportunities is actually backwards from designing a product and pushing it at audiences, but rather starting with what it is that people already have through data aggregation, and then figuring out ways and answers to optimize it. And obviously for human financial advisors, they do this all the time. So the ability to see crypto portfolios and then incorporate that into their planning process is quite natural, although you need to have a certain personality to do it. I know that Betterment's got a data aggregation layer. I think it was powered by Plaid a while back. And then that kind of connects into goals and asset allocations. Are there any plans to, link people's existing holdings on the crypto asset side into the Betterment experience?
Yeah, it's interesting. So when we set out to build this product, we spent a bunch of time talking with Betterment clients. One of the reasons that we designed the product the way we did is because clients said, hey, we have a bunch of crypto assets today distributed around, and we just don't know what to do. We don't know how to take the next step, and we're looking for sort of a easier solution. So we know our clients have these assets out there. In terms of kind of aggregation, I think the way we've built this offering and sort of this concept of choice, the way investors opt into it, the aggregation into Betterment in the current state of the product wouldn't add, I think, a ton of value, but we're constantly looking for ways as the industry continues to mature and evolve to simplify that client experience. And as companies like Plaid continue to build their digital asset tools, we'll keep tracking sort of ways to incorporate those within the Betterment offering.
I think there's a lot of interesting industry level strategy going on right now. In particular, crypto is much more vertically integrated than the traditional asset management and wealth management industry, in the sense that custody, exchanges, broker-dealers, RIAs, banks, and payment rails are essentially all sitting on the same infrastructure, which is much more general purpose. Whereas our traditional financial services industry has lots of little pockets of differently regulated, offerings and financial products, which are papered differently, accounted differently, and often are just a mishmash of stuff. And so I bring that up because I feel like the competitive vectors here for the audience you're targeting, it's a really interesting moment, because you've got Fidelity with its digital asset efforts. You've got Coinbase trying to package things up more and more cleanly. You've got players like SoFi and Robinhood adding kind of self-directed crypto investing, which is really just omnibus accounts on top of, Paxos or Zero Hash or things of that nature. How do you look at the strategic vectors going on in this industry, and how do you see them playing out over the next couple of years?
It's fascinating. I think when I started here in 2018, the thesis was that the exchange industry was going to get consolidated pretty heavily, pretty rapidly. Like that was the general perspective of most of the investors that we talked to, and everybody was concerned about fee compression and that those weren't going to be sort of viable long-term business models. And you haven't seen that, I think, or you haven't seen it sort of from an acquisition perspective. You've seen attrition of platforms, but we still have this proliferation of venues, those venues trying to sort of figure out how do they differentiate amongst each other. So I think time will tell on sort of if and when we see an industry consolidation in that capacity. The liquidity of these markets sort of in this era of tightened crypto credit that we began sort of post Terra Luna collapse in May, that has just continued through all the spread of the contagion from then the FTX collapse. Like that has made the broader exchange experience, it's just brought sort of some more light into how many exchanges there are, because the fascinating thing, like if you think about traditional assets, you get this T+2 settlement. And you get these consolidated venues. There's time for market makers and liquidity providers to sort of to settle their offerings. In crypto, you have to have those assets on these exchanges to provide that liquidity. Like it's sort of instant settlement in that respect. And so you need market makers to have collateral, like to have their assets distributed all over the place. And so with tightened credit, these market makers then sort of have to prioritize specific trading venues, and it puts pressure on some of the smaller players and the liquidity available at some of those smaller players. So we'll see if that sort of pushes more consolidation over the coming months. But I don't think this is an industry where sort of trying to break out all these different functions, trade execution and clearing and custody, into separate entities. I don't think that works here. I think sort of the structure that we have is the most efficient. And what we really need is more regulatory clarity and really regulatory focus on guaranteeing things like proof of reserves, guaranteeing things around transparency of asset holdings, so that really that kind of client confidence and trust can exist here without beyond just sort of the opaque world that we live in today from many of these exchanges.
There's so much more that we can discuss, and I found the conversation really interesting and enlightening. I think this combination of digital wealth and crypto assets finally coming together in a consumer packaging is really fantastic. And, I have a conviction that more and more people are going to be accessing digital assets this way. And I think that they should. I don't think that it's healthy for people to be in the crazy dopamine world of constant trading and being caught up in the hurricane of that industry, but instead try to take a much more mature approach to investing and build portfolios that are meant to last. I want to thank you for joining us today. And if our audience wants to learn more about you as well as about Betterment's crypto investing product, where should they go?
Yep. So I am on Twitter at Jesse Proudman, or you can reach out on LinkedIn. And Betterment has all the information on our crypto offerings on our website at betterment.com.
Fantastic. Thank you for joining today.
Thanks so much for having me.
Hi, everyone. That's it for this week's episode of the FinTech Blueprint. For more technical deep dives into all things FinTech and decentralized finance, check out fintechblueprint.com and grab a free subscription to the newsletter. This is Lex, and I'll see you next time.